the Fed is looking to stimulate, I guess interest rate cuts would be more likely, and the market is increasingly thinking about that, isn't it? We'd seen a few months ago, or a few weeks ago even, the market had moved away from that talk of interest rate cuts, kind of guided by the Fed, saying it was patient and could see rates going either way. And now the market seems to be, once again, weighing up the idea of rate cuts.
I actually think the outlook's reasonably clear, which is that in 2020 we will probably, with an agreement on trade, we will probably end up with US growth of around 2%. If we have no agreement with China on trade and the trade conflict escalates further, then it's entirely likely to see US growth next year as low as 1% or even lower. Under any scenario, we are very likely to get a cut in interest rates in 2020. Now, the market, as you say, is now discounting a cut in rates this year. And I think that will only happen if the trade conflict escalates and we get American tariffs on this further $300 billion. So it is totally dependent upon trade. Just coming back to Ben Bernanke's comments on QE, I would actually argue that QE has been totally successful, because if we actually look at the last 10 years, you know, we've had deleveraging by the corporate sector, the banking sector, the public sector, and the offset to that was a leveraging by the central banks. And if you hadn't had that leveraging of central bank balance sheets, then I think we would have had an even worse growth outlook over the last 10 years than we have had.
And it was interesting, though, that he was downplaying any of the side effects of it, and some would point to the sort of wealth distribution effects that maybe you can put at the door of QE.
Well, the bottom line is that QE has boosted asset prices. And
so if you had assets...
If you owned equities, you've done well. If you didn't own equities, then you've obviously suffered a negative wealth effect. And it's quite interesting that in 2018, when all asset classes except cash generated negative returns, that was the year when the Fed shrank its balance sheet from around 4.4 trillion to where we are today at about 3.9 trillion. So I would argue there is a very high correlation between the size and the movement in the Fed balance sheet, global liquidity and global equity prices. Now, at the moment, they are stabilizing their balance sheet, which actually was one factor why equity markets until 10 days ago did so well.